It's me. Y'all on level 1, I'm level 3. Pounding on the table for my team. Every night I flex, I'm making big moves. That's a big move. Big money, big move.
Ladies and gentlemen, welcome back to Pounding the Table. We are joined here by Dom Rinaldi and Brian Feroldi. That is a fantastic thing to say back to forth. You guys may be some long lost cousins here. Tony is out in the metaverse somewhere picking his next NFT. So we got Dom on my sidekick here today. So Dom, I know you're super excited. Brian's someone that you've introduced me to over Twitter, and great follow. So super excited to have him here, but I know you wanted to quickly introduce him yourself.
Yeah, for sure. I look up to Brian. He's kind of like a role model for investing, like my older brother. I've been following the Motley Fool for now going on 2.5 years individually investing, and Brian was one of the first analysts. So Brian has over 199,000 followers on Twitter. And he's very good about his mission statement too. You'll learn through his checklist that he's very particular about having a short mission statement, and his is to spread financial wellness. And he's done a great job. He's an analyst at Motley Fool, as well as a YouTube channel starting out, and very well known in the FinTwit universe. So Brian, thanks for joining us.
Avi and Dominic, great to be here. Thanks for having me.
So the first thing we want to cover today is Brian's story. Where did you start with investing? I know that before the Motley Fool, you had a history before investing, and kind of how did you end up at the Motley Fool moving forward?
Sure. So I graduated college in 2004. While I was a business major, we barely talked about the stock market like at all. In fact, it was only mentioned a few times, basically on accident in classes that I had. We never had like a detailed class where we went over what is a stock, why is it valued, and any of that. And again, I was a business major. We talked about accounting, we talked about legal, we talked about that kind of stuff. Nothing about the stock market. So I knew nothing when I graduated. After I graduated, my dad handed me a copy of the first personal finance / investing book I'd ever read. At the time, it was very popular, called Rich Dad Poor Dad by Robert Kiyosaki. I devoured it. It was the first time in my life that I'd ever read something that said, everyone's in business for themselves. Buy assets with your income. You can become rich in 1 generation, etc. All very common sense things. However, it was just the first time I was ever exposed to that. And I just immediately took to it. Like, I think I always had that mindset and ethos in me, and it was the first time that it kind of got unlocked. From there, I just started devouring any financial content that I could get my hands on, books, audiobooks, podcasts, websites, etc. And this was still in the relatively early days of the internet. That led me to the Motley Fool's book at the time, which is called the Motley Fool Investment Guide. I gradually went from there to fool.com and started reading all of their free articles. I was buying and selling stocks in 2004, 2005. I was not investing. I was just buying and selling stocks. My only goal was, how do I buy a stock that goes up 20% tomorrow? That was it. Like, I had no knowledge of financial statements, business analysis, management, competitive advantage, nothing. And I did terribly, just absolutely terribly. I got my teeth kicked in plenty of times. But I gradually increased my knowledge about investments. I gradually became a paying member of the Motley Fool. That just opened up a world of knowledge to me. And one of the things that the Motley Fool does really, really well is they have these private discussion boards where people can exchange ideas and analysis on companies. And I just spent hours every single day reading through there. And I found some people on there that were just extremely generous with their time and their teaching. And just purely by osmosis, over time, you just learn how to invest better and better.
Awesome.
I just got married, so this is a personal question. As you start the family, and in a few years, I'll probably have some kids. Like, how do you balance, right? Like, and find time to do all this DD? I don't know if you have children, a wife or whatnot, but like, how do you balance, within your life, just finding time to actually do this deep dives into companies?
So I was lucky enough to get really interested in investing prior to being married, prior to having children, prior to having any of those real huge time obligations. So I put in a lot of time in upfront. I am married. I do have children, and I've been blessed in my career to be, prior to working with the Motley Fool, I had a job in sales. And one of the enormous benefits of being in a sales role is I was in my car 30 to 35 hours per week. I mean, I was driving around nonstop. Some people use those 30 to 35 hours to listen to Howard Stern. I used all of those hours to listen to podcasts, to listen to audiobooks, to listen to conference calls, to basically educate myself. And that really afforded me a huge block of time where I was basically being paid to be at a university in my car. More recently, now that about 6 years ago, I transitioned to being a full-time contractor for the Motley Fool. And I basically work 7 days a week, but I say work in air quotes because I don't consider this work. I consider this like I was doing this for fun in my free time before, and now it's just what I do full time.
I'm sure your family appreciates that too as well, right?
Yes, that's a constant thing. We've had to come up with some rules. For example, I'm not allowed to touch the computer after 7 p.m. And things like that. But it's always a balancing act. But working from home and loving what you do, those two things make it work.
Oh, totally. And I have those same rules in my house as well. So very familiar with that.
Yeah, Dom's not allowed to do spaces after a certain
yeah,
hour.
we actually have to do Twitter spaces. I have a curfew to adhere to, make sure I have time with the kids and fam. So could you walk our viewers through your investing philosophy and how it's changed since buying and trading and trying to make that quick 20% to now really being a more involved long-term investor looking for quality businesses?
Yeah, I've tried just about every strategy that you can possibly think of and failed at all of them. And that has really led me to be the investor that I am today. Just observing the market, watching what works, watching what doesn't. I firmly believe that the best way to invest for the long term is to buy and hold the highest quality companies that you can find, period, full stop. That is both simple in explanation and really hard to do in real life. And believe me, I've tried really hard to make short-term investing work. Like I've tried to find companies that were going to go up quickly so that I could book a profit, so that I could reinvest. In my opinion, that is not a game that I'm good at playing. That's not even something I try to do. And the funny thing is, when you look at some of the best investments over the last 20 years, they're companies that we've heard of. Apple, Amazon, Netflix, right? These are companies that we use in our real lives. And if you just had the foresight 20 years ago, 15 years ago, 10 years ago, even 5 years ago to say, hey, that's a good business, and buy it and hold it, you have done extraordinarily well. And I am now after trying to find the highest quality companies that I can find. I determine quality by taking them through an investing framework that I've developed over the last 15 years or so. And my framework has been built on trial and error in my own investing life. And it's also been refined by sharing it publicly and having a tremendous amount of feedback from other investors. But I now use this framework to evaluate any potential investment that I come across. So I check the company's financials. I check the company's moat. I ask myself what the potential is. I think about the way that the customers interact with the company, how high quality the revenue is, what the management is, how well the stock has performed on the market so far. And then I subtract out all of the things that I've messed up in the past. I check for example, customer concentration or industry disruption, or if there's an outside force that the company is successful, needs to go well, or if it's growth by acquisition, or if it's high dilution, etc. So this framework allows me to take any company that I come across, run it through it, and it spits out at the other end a quality score. Now, the score itself that's not that valuable. Whether a company is like a 75 or a 79, that really doesn't matter to me all that much. What really matters is it forces me to go through the same process with every single company. And what you discover along the way is really where the value is.
Do you ever do like a bear case? Like if you love a stock, will you flip yourself and try to take the bear stance on the same stock?
So that's kind of what the end of my checklist is. That is a list of all the things that could go wrong, or the really big risks that are out there that I come across. I guarantee you that list is going to grow over time as I screw up and buy things that I shouldn't. But going through that part of it is sort of a bear case. But I've also learned that investing is really an odds game. What I'm really trying to do with my checklist is increase my odds of being successful and decrease my odds of being unsuccessful. No checklist, no matter how fantastic it is, will ever be 100% correct. So the bear case is always important to think about, but you can also, if you really focus on the bear case, you can talk yourself out of anything. Like every company, every great company sounds dumb when it's very early on. So I've since learned I protect myself from that risk by positioning the sizes appropriately in my portfolio.
And you've stated publicly, sometimes there's great companies that score not so well on the checklist up front. One that particularly jumps out at me is Pinterest. And I believe you still hold Pinterest, is that right?
Yeah, when Pinterest first came public, I took it through my checklist, and I think it was like just a rough scale. It's a 0 to 100 point scale. Anything over 80 is basically, why don't I own this category? Between 70 and 80 is like investable, and below 70 is in my why bother range. So that's just a rough scale of it. When I first ran Pinterest through the checklist, I think it scored like a low 60 or something like that, which was just in my why bother category. However, one flaw or one downside to my checklist is it unfortunately punishes newly public companies. Like that's just, I like to check out market history. I like to see how the company does versus analyst expectations, et cetera. So there's a couple things in there that punish newly public companies. When I first took Pinterest through, I think it scored like a low 60, which is normally in my why bother range. But qualitatively, it's my wife's favorite company. Like it is the website that she enjoys being on the most. And I just knew for her that the brand name Pinterest just was very, very attractive to her. And I inferred, well, she can't be the only one that just loves being on Pinterest. So while it didn't score well initially, I still took a position. Now, my scores are dynamic. They do change over time. And as Pinterest was a public company for longer, the score actually improved. So it actually scores very well in my checklist today. So that's just something else to keep in mind. Whenever I score something, it's like the score today, but it can change because companies change over time.
So quick questions. I came from a tech sales background. I've been doing it for about 10 years. Dom as well. He's in cybersecurity, but it sounded like you came from a medical device background. So has that played a role? Because like I'm more familiar inherently with tech stocks, right? So do you kind of invest in more medical or technical stocks?
Yeah, sheer luck out of college, I got involved with a startup through just a family friend that took me on in this interesting medical device company. I didn't know anything about the product, the company, or anything. It was just kind of like a first job. Sheer luck. That company turned out to be ridiculously successful. It's worth approximately, off the top of my head, somewhere around $20 billion today. It's publicly traded. Yeah, publicly traded. And working at that company, I got to see a company literally go from the R&D phase all the way through till $20 billion publicly traded market cap company. And when I was working for this company, we had a revolutionary product that was like unlike anything else that was on the market. And if you knew not that much about the market and you just saw the product and compared it to what existing, it's a no-brainer. I mean, you wouldn't for a second consider the legacy product. So I was hired. I moved into sales to try and sell this product in the market, and I was like, this is going to be easy. Like this is like a no-brainer choice, and you would not believe the resistance that we hit as a company trying to commercialize this product. so many doctors and providers that we came across did not want to change what they were doing.
No.
They were extremely resistant to our technology. Even again, if you looked at it as an outsider, you'd be like, there's no choice. Their product is the better one. So that taught me just how high the switching costs can be in healthcare. The other thing that it taught me is the company, it's called Insulet. The ticker is POODD. I vividly remember in 2005 when we launched the product, our CEO was up there and he said, we have a 3-year head start on the competitor. We have a 3-year lead before you'll see anything that competes directly against this product. It's now 16 years later, and there's still not a direct competing product on the market. And that's because just the nature of healthcare, there's a long regulatory approval process. There's the R&D you have to go through. There's the patents, there's launching it, there's getting healthcare support, there's reimbursement. So again, all of that kind of showed me firsthand just how durable a moat can be in healthcare if you build it properly.
Now, with investing in your history with working at a healthcare company, you lean towards technology and healthcare stocks. Is that a fair assessment? I mean, as far as your portfolio, you kind of stay in your area of expertise because you know it really well.
Yeah, that's correct. So the two areas of that I think are the best hunting ground for investment ideas are technology and healthcare. Of course, those aren't the two exclusive ones, but those are the categories where I think the economics are the best, the long-term growth drivers are the best, and companies can really establish a unique position for themselves.
So kind of transpiring now into bringing investment into our personal life, we've heard you talk a lot about the FIRE movement, right? Financially independent, retire early. What advice would you give towards new investors or even seasoned investors around working towards financial freedom, and what's worked maybe for you personally?
Yeah, again, getting back to that Robert Kiyosaki book that I read almost 20 years ago now, that was the first time in my life I ever heard of the concept of being financially independent or being rich enough or wealthy enough that you are in control of your life. Like nobody can tell you what to do if you have enough money in the bank. And again, that's a concept. The first time I heard it was like, yep, that sounds exactly what I want. Now, the FIRE movement has grown tremendously over the last 15 years. And I previously thought that the RE part of that was what I really wanted, retire early. I have since essentially dismissed that outright. I don't think anybody really wants to retire early. If you're after retirement, that just means you don't like what you do on a daily basis.
I've never heard that.
If you really love what you do on a daily basis, or you love your career, retiring does not sound something that's all that appealing. I mean, the classic example there is Warren Buffett. He could have retired early, 60 years ago at this point, but he's in his 90s and still tap dances to work because that's what he loves to do with his time. So I'm a huge proponent of the financial independence part. So you can choose whatever you want to do with your time. But my big advice to any listeners there is just, first off, learn about it, study people that have successfully done it, and then ask yourself, even if you don't want to go towards financial independence, even if like the idea of saving 50% of your income just sounds completely unappealing to do, study the people that have done it, because I don't care who you are or which stage you are in your life, you will learn something. You will learn something that those people do that you can apply to your life to just nudge your savings rate a little bit higher, to pay down some debt, to save a little bit more, have a little more cash in the bank. And those actions that you take will just dramatically improve your financial life. And your financial life has a huge impact on the quality of your actual life.
I definitely agree with that. Can we just talk a little bit more about kind of your portfolio? I don't need to obviously go through all the stocks you're holding today, but as you start to analyze some of these stocks, like, do you have a limit where you have 10 or 20 at any time, and then do you add to 21, or you push one out? Typically, you'll try to keep to that specific standard set.
So I have a spreadsheet that I created for myself where, again, I've taken now hundreds of companies through that investing checklist process that I've gone to. And that's just by doing them literally one at a time. So that's how I kind of got to where it was. However, going through that process, sometimes after I'm done with that process, I would just immediately say, this stock ain't for me. Like I am all done with this company for the rest of my life. It could do fabulously well. It could do terribly. I don't know. I don't care. It's just not for me. The ones that sing to me in some way, that capture my attention in some way, typically because they meet the vast majority of the criteria, or I think the upside potential could be enormous. Those go onto my watch list for potential buys. The way that I buy or choose what to buy on any given a month is when I have fresh capital to invest, I look over my portfolio and I ask myself basically three things. What are the highest quality businesses that are on there? What companies have the highest long-term growth potential? And what companies are trading at the most attractive valuations? And whatever companies kind of bubble to the top of those three things, quality, potential, and valuation, I try and add to my portfolio.
So you have this 3% rule. I mean, is it as straightforward as 3% per position, or am I thinking about this too simply?
So this is a loose framework that I came up with because, again, I've made mistakes on this previously. If you look at my portfolio today, I own about 70-ish stocks, somewhere around there. And you would think that, oh, that's way too diversified. You'll never outperform the market with that many. But if you look at my, say, top 20, my top 20 positions are somewhere around 60 or 70% of my portfolio. So I am relatively concentrated into my top ideas. One mistake that I've made previously is I have personally become way too bullish on any one company, and I tried to force that company into being my top position. The company I made this mistake on was a company called Kinder Morgan, which is a pipeline operator. And again, it checked so many boxes in what I was looking for in investment. Founder-led management team, recurring revenue, predictable demand. They had these take-or-pay contracts, so didn't matter in theory what energy prices does. This company was getting paid, and I was like, I am so confident in this company's future and growth potential that I'm going to make it a 5% plus position. And then on top of that, I layered in a bullish options strategy to basically increase my position even more. Spoiler, that company then went on to fall 70%. Even though I was 100% confident that the company's stock was going to go up. And I had a heck of a time trying to unwind my ridiculously bullish options position. So that was a very painful lesson. Now, at the same time, roughly 10 years ago, I became an investor in Mercado Libre. And I took a small position in that company. And if you've known anything about the history of Mercado Libre, it's been one of the best investments you could have made over the last 10 years. And without me doing much work, it just grew and grew and grew into one of my largest positions. So just seeing that in action taught me I don't always get what companies are going to do well right, but the market share does. So because of that, I've set a cap for myself to say whenever a company becomes 3% of my portfolio or more, I stop adding to it. Full stop. I will stop adding to it. From there, it's up to the company to earn a higher percentage of my portfolio. Now, I'm not going to sell a stock that goes up. In fact, I try and do the opposite. I try and sell stocks that have gone down, and I buy more of the ones that go up. But by doing so, it prevents me from making that catastrophic mistake again of being 100% certain of a company's future and being wrong.
Now,
Why do you think this
ever violated that rule?
Not since I created it, but I only created it a couple of years ago.
I was just curious what happened with like Kinder Morgan, and like, so I have, some big positions that I fall in love with, right? ShareCare one, currently that I'm looking for. And obviously it's a SPAC. So there is, that fear of dropping at any time. There's a lot of shorts on those. So like, at what point do you do you just pull the thread and you're done with Kinder Morgan, or since you believed in it so much, or do you just wait it out and time, eventually wins for you?
Yeah, that was a wonderful learning lesson for me. Boy, was it painful. And it was the biggest dollar loss I've taken so far. But I learned a lot from owning that loser. Owning Kinder Morgan really taught me a valuable lesson, which is don't buy companies that are reliant on an outside force, namely commodity prices, for their success. And as a reminder, I didn't think this company was reliant on an outside force for success. One of the reasons I liked it is because these contracts, in theory, protected it from changes in commodity prices. What I got wrong was, well, yes, Kinder Morgan is protected, but you know who's not? It's customers. Those customers, when oil prices collapse, their revenue shrinks and they have a hard time paying their bills. So it doesn't matter that those contracts are in place if the person on the other side of the contract can't fulfill their obligation. So that is something that I got wrong. And when I learned that dynamic, I said, well, I have no ability to predict energy prices in the long term. Therefore, I have no ability to predict which direction Kinder Morgan's going to go. Therefore, with so many other high quality businesses out there, why would I bother with this one?
So switching gears a little bit, talking about people of influence throughout your investing career and who've made you the investor you are. Maybe they've also too contributed to this mission statement you have, which I'd maybe even like you to elaborate on, of spreading financial wellness. Who are 3 investing role models that have really instilled in you your priorities in investing and how you invest?
I have learned from dozens of investors, if not hundreds at this point. So it's hard to boil it down to 3, but I will give a shout out to 3 people that I would say have had a bigger influence on my investing style, more so than any others. Number 1 would be David Gardner, who is the co-founder of the Motley Fool. He has been investing with a rule breaker mindset for basically 20 years. And when I first learned about his investing style, I said, this guy's nuts. Like, he is recommending stocks that have already gone up hundreds of %, are trading at 100 times price to earnings ratio. Like, he's going to crash and burn. And only by observing him and being proven that I'm wrong, he's right again and again and again, have I really flipped to believing in his style. And his style is find excellent companies, buy excellent companies, sell mediocrity. And valuation for him is the 20th thing he cares about. For me, when I first started, it was the first thing that I cared about. And I just learned if the lens you look through when you're investing is valuation first, you're never going to own the next Amazon. You're never going to own the next Mercado Libre. You're never going to own the next Tesla. So he had a huge influence on my investing style and philosophy. Number 2 would be a guy named Jeff Fisher. Again, a Motley Fool employee. He is a fabulous investor that I would say his style is high quality compounding machines combined with like GARP, G-A-R-P, growth at a reasonable price. So he taught me that you can be super demanding of your investments and you can get it. You can say, I want high growth, high margins, high returns on capital, free cash flow, perfect balance sheet, founder-led management team. I want tons of optionality. You can say, I want everything. Boy, does that limit the universe of companies that pass your criteria, but they're out there. You can be demanding of everything. And his style is just demand everything and only let those companies into your portfolio. The third and final would be a guy named Tom Engel. He was, again, I found him on the Motley Fool's discussion boards. He has been living off his portfolio now for 30 years. He retired in the 1980s, and he was an individual stock picker way back when getting information was insanely hard and buying and selling stocks was insanely hard. But he taught me a lot about his valuation framework. So he tries to find companies that he think can grow for decades, and then he strategically buys those companies again and again and again at better and better valuations. So he's more valuation focused than someone like David Gardner, but he's first focused on find awesome companies, then strategically buy that company again and again and again by watching it and paying attention to the valuation over time.
Your session on Motley Fool with him was phenomenal around the trade desk and just his process and how he goes over stocks and how he even just said, I can see the trade desk, paying a dividend soon. I can see that I have no problem buying the trade desk, larger market cap, but better valuation. And he walks you through that in the conversation, and learned a lot from both of you on that. It doesn't necessarily the market cap. You want to look at that price to sales or that PE. Are you getting in at a better value?
Yeah, that's a fantastic lesson. He's one of the most calming voices I've ever come across when markets are going to hell. Like when markets are falling straight down, he is filled with glee and excitement. So he is a great counterbalance. If you ever were like, I don't want to open my portfolio brokerage statement, but I'll just go and ask what Tom's thinking.
Quick question on that. So in terms of your like cash position for those instances, if the market's crashing, right? Do you always hold 3% cash, or do you have a larger cash position for that then?
So I hold two positions of cash, and I'm going to keep them distinct and separate. First, I'm a big fan of emergency funds. So I have a cash position just sitting in a checking or savings account, earning zero. Because that's what they pay nowadays, but that is separate and distinct from the cash that I keep in my portfolio. So I don't consider that money investable. That is just in case something happens catastrophic in life, it's there to provide that. Of the cash that I keep in my portfolio, it roughly fluctuates between 0.5% and 5%, depending on what I'm seeing in the market. Sometimes it seems like it's raining gold, like it was in March of 2020 when prices were collapsing. Other times, like now, when valuations are high and everything's stretched, there are still plenty of great stocks to buy. But I'm not like foaming at the mouth today to get anything into my portfolio. So it does fluctuate a little bit. I know some people that say I keep when prices are high, I keep a 30% cash position. I know other investors that say I'm always fully invested. Always. And because the market goes up and that's my style. I think this merits to both. And you can also make the argument to me holding any cash is akin to market timing, which I know that I suck at. But that's roughly what I'm comfortable with.
And just like, we've mostly been focused kind of on individual stocks, your investing style, but how much do you look at like the macros? We had Jem Carson on, I think it was last week or the week before. He's really focused on the macros and the massive flows. Like, are you looking at, outside events? And if so, I'm assuming you do to some capacity, but like, how much do you look at stuff coming down the pipeline, like tapering they've been mentioning recently?
Zero. I pay zero attention to the macro environment because I don't think I have any ability to predict it, and I don't trust anybody that I frankly don't trust anybody that makes market calls about macro events. Anybody that thinks they understand what's happening in the macro is dramatically underestimating the complexity that takes into account the macro. And it's easy to spin up a narrative based on what the Fed's doing or what fund flows are doing, but I've seen so many times people make calls based on because of A, B, C, D, next coming is D, E, F, and it makes complete sense. And then the opposite happens.
Right. Fate loves irony, as Tony would say.
Yeah.
Quick question. So we're interviewing you right now, but you also have your own podcast and you've done great interviews in the past. Like, of all the CEOs, is there one that kind of sticks out to you as one of the most interesting conversations you've had?
I don't do a ton of CEO interviews. I have done a couple dozen. So there are some great people out there that do wonderful CEO interviews, but one that sticks out to me is a guy named Bill Doyle, who is the executive chairman of a company called NovaCure. You guys ever heard of them?
I'm a shareholder.
Okay. So I had the good fortune of interviewing Bill in like 2017 or something like that, because I found the company's technology to be fascinating and really hard to wrap your head around, and it sounded like magic / voodoo when you get into it. The gist is they make a cap you put on your head and it fights cancer. Sounds again like magic. It sounds like magic. Like, no way is this legit or anything like that. But they actually have clinical data to prove that it helps to fight brain cancer. But after sitting down with him, really understanding the technology, digging more into the company, that is a company that I have been bullish on for like 4+ years now. But after that interview, I was really like, I think this could be the real deal. And I still think that company has an incredibly bright future ahead of it.
I would agree. It's even now priced at a good point to add if you haven't got to that 3%. I've written several papers on him, and they're augmenting cancer, right? They're not trying to say, hey, we have the cure, and their pipeline is super robust with all the different things they're trying to do with their tumor treating fields for other kinds of cancers coming up. So
that's my favorite thing about the company is it's non-rival with other treatments. It's not something that is in lieu of surgery or in lieu of chemotherapy. It's an additive to those things.
Yes, very much so. And I think everyone thought it was like voodoo when it came to market, because there's so many people that doubted that company that it is
dig in.
work. And they've also been mindful too, when you look at a company that is trying to improve their products and a customer experience. They had these massive backpacks that you'd have to wear with the cap to use the device. And now they've shrunken it down to where it's so minimal to carry around as an experience, have quality of life while dealing with serious cancer.
Mm-hmm. Innovation is alive and well there for sure.
Very much so. So coming kind of to our close here on just your investing story and what you've done at Motley Fool and your mission. I just love it, to spread financial wellness. Boom. That's it, right? Like, I know when I watch you and Brian go over mission statements, people like to have these long, wordy, it's straight to the point. I'd just like to know what inspired you to, you tweet all the time, and I don't know how you do, like, that was one thing I was like, how does he do his full-time job, Twitter, has kids, a wife, how does he, because it definitely takes a toll to really put good quality content out there. But you make sure to always continue to put out stuff to help people to learn how to invest. So, how do you do it? And just like, what came to that point where you said, you know what, this is my mission. This is what I feel called to do. Because I think it's very noble.
Well, thank you. Well, like many people listening, I didn't know what I wanted to do when I grew up. Until probably 10 years ago. I think that I had no idea what I wanted to do when I graduated college. I chose business because it seemed reasonable and it seemed like flexible, but I didn't have any grand vision in mind for teaching people about money. I just kind of discovered that about myself because, again, when I learned about financial independence, when I learned about investing, I was immediately taken by it. And it still kind of floors me to this day. Like, why do only 1% of the population care about investing? Like, this is a way that ordinary people can become millionaires, like in not that long of a time, like 10 or 20 years, like normal people can become millionaires. That doesn't appeal to everybody. Doesn't that seem crazy?
That's 1%. That's crazy. We live in such a bubble. I think everyone invests.
Well, even FinTwit. FinTwit's a wonderful, wonderful place, but there are hundreds of millions of people on Twitter. What are the biggest FinTwit accounts have 1 million followers? So 0.3% of the population. So I just know from my own life. If ever I find somebody talking about the stocks, I'm like, oh, you're a weirdo too. Awesome. Let's be friends.
That's so true. So true.
So just interacting with people. Most people don't care about money. Most people don't care about investing, even though it affects every part of their life. And I've learned that this is my passion. This is what I'm into. This is what I like thinking about. This is what I like talking about. And I love teaching other people about how to do their money right, because it's something that none of us are taught. Again, I wasn't taught anything that I know. I just discovered it because I became interested in it. But I know that money and health are the two areas of life that it doesn't matter whether you care about them or not. They're going to have an outsized impact on the quality of your life. So I love teaching other people how to do their money and invest right, because that's just essentially what I was put on earth to do. I'm convinced of that.
Should be a financial advisor.
Yeah, I'm not interested in managing other people's money, because then that gets into the managing their emotions, and I have zero interest in that. I'm happy to teach them how to do it themselves, but I don't want to do it for people.
Well, Brian, thank you so much for joining us here at Pounding the Table. And you have your YouTube channel, you have a website or anything people should go to check out and learn more?
Yeah, the best way to connect with me is on Twitter. At Brian Feroldi. If you're interested in my checklist that I talked about for investments, every week, me and my co-host Brian Stoffel take a random company that we've never heard of, and we go start to finish taking it through our checklist, and we show you in real time how we research it and do everything. So that's Brian Feroldi on YouTube.
Awesome. Well, thanks so much, man. I really appreciate it.
Thanks for having me, guys.
Thanks, Brian.
Awesome.